1 minute to go. Okay, we have 1 week to go before our first exam, and that'll be given a week from today right here. And it'll be an online exam. I've sent you some information about it already. I'll send you some more. I'm making up a trial exam that I'll post. I currently plan to post on Wednesday, and that'll be a sample exam about 1/3 the length of the actual exam, so you can go onto the site, get used to the format, see how the timing issues work, see what it looks like and all of that. There will actually be legitimate questions. In fact, the questions that you'll be looking at in the timing exam will be on the actual exam, and they're all chosen from the data bank of questions that I've set up for exams for this class. So I'll announce that by email and in class on sometime Wednesday is my plan to have it up, and that will allow you to experiment with it, and I'll be able to say a little bit more about the exam format after you've done that. That exam will be left up for you to take from whenever I post it until late Sunday night, and then I'll take it down, or I won't take it down, it'll take itself down. And then on Monday, of course, it'll be replaced by a real exam. And you'll have to provide the exam with your email address, and you'll have to provide it with a password, which I give you in class. So I will give you various rules and so forth. You know already that if you're a student, with special consideration that setup has been made, and you'll get an email from me about how we're going to try to do that for all of you. I forgot to mention in that email, if you're a student in here and you're not here physically right now, so if you're looking at this video, if you're a student in here and we have a time conflict, then you will be required to take the exam at a designated time, probably that evening. And I'll send information out about that as well. So Tuesday or Wednesday, sometime this week. Also, as I pointed out, I'm going to give you an exam review video because we've covered a lot of material. So I want to hone it down and make you comfortable with what you think you need to know and what you don't necessarily need to know. I do that for all exams. I'll post that on Thursday or Friday. And let's see, I don't think there's anything else I need to say right at the moment. It does cover all of the material from the start of the class up to and including mutual funds, including Chapter 5 about mutual funds. And let me, in fact, go very briefly to the website for the course to make sure that you are using it properly. Basically, this is the page. Bill Gates. This is a constant war. Bill Gates. Just to see who's going to outlive the other one. All right, this is the page. Now, of course, these right here are the slides that I provide prior to the lectures that are in PDF format. Those of you sitting here in front of me are attending here, so you're not looking at the videos of these recordings, but the videos of these recordings have the mandatory videos in them as well, where it says mandatory, not delivered in class. And remember, this is one I delivered because I missed the class, the first one. 4C was the extension discussion of the .com crash, which I posted up on Friday or so. And there is one that was posted yesterday or this morning. Let's put it on, but I didn't put it here until this morning. And that is the supplement to the retirement account, Appendix A. It says very clearly in the course calendar that you're responsible for that supplement. And it says specifically Make sure you read Appendix A, the retirement accounts, and watch the video retirement accounts. And that's actually meant to be useful about what I expect you to know for the exam about the retirement accounts, because the document on the retirement accounts is dense and terse and compact, full of information, and I don't expect you to know all of that information. So make sure that you have looked at all of that before Sunday, probably. And then I still have yet to post 2 lectures because I have yet to give them. I'm giving this one right now, 5A, and on Wednesday I'll be given 5B. All of the reading material that you're expected to do has been online for some time now. So on the book, so down here we're reading through chapter 1, 2, 3, 4, and 5, and all of these have been posted ready for use in this class. And then the retirement accounts is here at the very end, this little brief thing that begins with that table about the different kinds of 401k plans and spousal IRAs. I'm not requiring you to know anything on this graphic right here, just some very sundry general comparisons that I outline in the video is clearly what I want you to remember. All right, so that should give you enough guidance to prepare you for the exam. I looked at the online version of the second exam last year, and that was coupled with an essay exam that I can't give this year because of the class size. But the online portion of that exam had an average score of 79%. So that seems to be about the right level of difficulty. And it was a 20-minute exam. Because it was coupled with the essay exam, this year's exam will be a 30-minute exam, and we'll have more questions than last year's exam. Okay, so now that we're online.
Will the exam cover the beta that you put out, the beta video that we had to watch?
Yeah. Okay, here's some background information that it was kind of relevant to what we covered, I think, in Chapter 2. It's kind of interesting or useful for you to know this. Okay, good, everything's working. Now, we talked about dividends, and in the chapter, I discussed what it meant to be ex-dividend and the like. And you may remember that what we said is that all stocks that pay dividend a couple of weeks ahead of time will announce the day that their stock is ex-dividend. And that's the day that you have to be owning the stock if you are expected to be paid the next dividend. And so that is going to be before the dividend payment and usually precedes the dividend payment by at least 1 month. Now, for significant stocks, the dividend ex-dividend date actually impacts the stock price directly on that date that it goes ex-dividend. This is the example for SPY, the tracking stock for the S&P 500, which went ex-dividend on June 21st, 2019. This blue bar, which actually shows up on Interactive Brokers, indicating that the stock has gone ex-dividend, so you'll know that it did, shows that the moment the market opened on that date, that the stock dropped by the amount shown there. And that's because you have to own the stock, if that is to say the ex-dividend date was the day before. So if you were to buy the stock on the date where my cursor is, or you can't see my cursor obviously, on the red line at the bottom of the blue bar, you will not be entitled to the dividend. And that's why, of course, the stock drops. Or to put it the other way, the day before, those relatively high prices are there because whoever bought that day would be entitled to the dividend. Now, the close on the dividend day was $295.86. The next day, it was opened at $294, down to $1.86. The dividend to be paid was $1.43.2, and the adjusted close, therefore, was about the same as exactly the dividend. Now, the payment itself for the dividend was made exactly not 1 month, but 1 month and 10 days later on July the 31st, 2019. So this kind of dynamic plays out a little bit on dividends. You have to know if you care about the dividend, when the dividend goes, when the stock goes ex-dividend. And again, the payout is not at the same time. The payout comes considerably later. So if you buy the stock after the ex-dividend date, you don't get the next dividend. therefore, stocks and options take the hit on ex-dividend day. Now, the big deal really is for options trading, because options are hugely leveraged. So if you're trading options, you absolutely have to know if a stock that you're trading options in is going to be a dividend, as we'll see when we get to options. So the stock and options take a hit. The payment is made a month later. Equally important, when you go to Finance Yahoo or any data source that has open, high, low, close data historically that you're using for analysis, it has a column called adjusted close, and the adjusted close column is adjusted for dividend payments mostly, but also adjusted for stock splits. So if you take a look at, this is an excerpt from Yahoo up here that we're looking at, Finance Yahoo, June 21st, 2019. And so, and then it shows the dividend being paid. It's not paid on that day, but ex-dividend on that day. And so you can see the column that at the top is labeled 292.65 is the adjusted close. The column that is labeled 294 is the close. And so that's why that varies. And you can see this, as I say, what happened between June 20th and June 21st is June 20th, the close was 295.86, and it fell to 294. But the adjusted close fell from 293 to 292.65, a smaller decline because $1.43 of it is explained by the fact that the dividend is paid. That doesn't mean anything to you, and in fact, I'm not going to hold you accountable for that specific example, the difference between close and adjusted close. But if you're doing research using stock data, you better know this, right? If you're running across time series data with all of this, you better know what the difference between adjusted close and close is. Okay, so, and this is a good example because this is a big stock. Now, this is not required. I think I sent this link to you, but there's a couple of articles that'll give you some background upon why WeWork is turning out to be a disaster. And one of those is the Wall Street Journal article. He's since been fired as CEO. That happened over the weekend. And you're not required to read this. Read it only if you're interested. But this is why the IPO market's having a tough time. And so those two links will give you something to chew over if you're curious about that. It may be that WeWork never gets their IPO done. It has impacted other IPOs. Peloton had a terrible IPO on, it was either Thursday and Friday or just Friday. And that wasn't expected, actually. And so that's caused the withdrawal of the big Endeavor IPO that was supposed to have happened tomorrow. And that withdrawal has been postponed indefinitely. So the IPO market is getting really rotten because of the poor performance of Uber, Lyft, Peloton, and a bunch of others that this year have not performed the way they're supposed to perform. And to some extent, this is the problem. These kinds of stories like you'll read about here, the outrageous behavior of Adam Neumann, has drawn so much attention from the general public that it's had a toxic effect upon the IPO market, as it should. This kind of nonsense should be met with indifference, if not downright just boycotting the market. We know that the repo crisis goes on. I don't have the luxury of saying much more about it, except that it continues. These are two articles that have appeared about it. In Sunday's Wall Street Journal, the one says, "Why were they surprised?" And in today's morning Wall Street Journal, the one down on the bottom, Fed adds $65.3 billion to the financial system in repo transactions. And the graph up in the top, I'll explain later in the class. We don't have time to cover this right now. And so, according to today's Wall Street Journal, this series of transactions, which was supposed to happen only on one night, the night of September the 17th, not only continues unabated, but they're certain it will continue to at least October the 10th. In fact, the Fed is beginning to sound like that's when they would like to terminate it. And $200 billion has already been added to reserves with no explanation about why. And there is still absolutely fundamentally no explanation about why this is necessary. You would need to understand, again, the technical nature of the reserves and what they're used for, and why their abundance in recent years would imply that they shouldn't have to do this. But you can take it from me, there's no reason why they should have to do this, except I don't think anymore that this is tied to a feared financial failure of any kind, because a rumor mill would have exposed who that is by now. And there's nothing being said about any of this. Nobody's even trying to explain it anymore. But if there was a troubled bank, or if SoftBank's going to fail because of WeWork or something like that, we would have heard about it by now, and we haven't heard about it. I'm beginning to think that very possibly it's a bank boycott of this structure, because I know banks are very unhappy with this recent decision to continue to push interest rates down to historically low levels yet again, because that really hurts their profitability. Banks make their money on the spread, not the level of rates, but when rates are this low, the spread is very narrow. And so it may be that banks are more or less boycotting the system by refusing to offer their reserves to the overnight market. But nobody suggested that. That's just a guess on my part. So we'll just continue to monitor it and wonder about what it's all about. But we have to move on from this and go into a discussion of mutual funds right now, because we're running out of time, and I have to complete these next two lectures. This is where I was supposed to talk about the exam. Well, I've already said all of this. It's a week from today. Down at the bottom, like I say, I'll post more information about the new format online this week with the voluntary trial exam. So I've said all of this, so this is just a reminder of it. Okay, we have, in talking about mutual funds, we have had one exposure already to the suggestion that we need to think of these investments as portfolios. What you will have in the name of investment will be a portfolio a few years on down the road. Your 401k, consisting of maybe 4 or 5 different types of securities, will by definition be a portfolio, because a portfolio is a mixture of securities that is owned by a single party or a single institution of some kind. And so it's going to be useful for us to think of our financial assets as constituting a large portfolio. And when we think about our investment health or strength, we think of it in terms of the health or strength of our portfolio. We often represent the portfolio, at least graphically, as a pie chart that represents the relative proportions and contributions of the components of our portfolio. And then we can talk about why that changes over time, or why we might want to change it over time, and that can be a constructive discussion. This will enable us, among other things, to consider trade-offs between risk and yield in alternative portfolios, and we'll talk about that a lot beginning with today. And it encourages us to consider rebalancing portfolios in the face of changing economic, political, or financial environments. So as we talk about moving to a more risk-adverse position, for example, because of rising fears, that would normally be thought of as triggering off a portfolio shift of some kind, where you and others like you would be selling off certain assets in your portfolio and using the proceeds to buy other assets for your portfolio that are lower in risk, but presumably also lower in long-term potential yield. So we begin to think of reactions to changing market conditions as resulting primarily in portfolio shifts. And those portfolio shifts and their analysis is what drives a lot of financial analysis or financial theory. Remember that as we consider portfolios consisting of bonds and stocks, bonds are considered to be safer than stocks but offering lower yields. So for the time being, we'll sort of accept that old axiom. When we're talking about securities like U.S. Treasury securities, we're going to view them as typically, at least, having lower yields than stocks, but also having more safety. We're going to see that there are many exceptions to that, especially in transitional periods. But for the largest part, we'll start with that consideration. We can therefore adjust for risk by rebalancing the composition of our portfolio to alter the relative proportions of stocks and bonds. When times are getting tough, we can sell off stocks, use the proceeds to buy bonds, or in reverse. Now we'll continue to refine this throughout the semester, now that we've introduced it. We can't go very far with the bond part without a big long set of lectures on bonds, and that follows the exchange traded product lectures, so that's not far away. Let's take a look at a portfolio that is age-based as a hypothetical portfolio to sort of introduce you to this portfolio management concept that's implicit in what I'm saying. So here's someone age 45, and this might be the portfolio that you would have at age 45 adjusted for today's dollar. And you'd say, well, you own stocks and ETPs outright at 11.3% of your portfolio. And what we'll do is we'll adjust this portfolio as circumstances change. The bulk of your portfolio is in mutual funds that are work-related for your 401k and the like. That constitutes about 33% of your portfolio. You have some bonds, but not very many because of your young age. That's 6.7% of your portfolio. You, of course, hold bank deposits, but bank deposits are not good investments. They don't have a high enough rate of return, so whatever bank deposits you have are for liquidity needs and nothing else. You have some real estate equity in the home that you own. You own some commodities or collectibles, and we won't specify right now what they are, but maybe it's silver or gold or art or a rare automobile or something. And you may have annuities and insurance products, perhaps inherited from your parents. And so we say this is fairly complicated as portfolios go, but not unusual for someone who's sort of upper middle class in terms of income, has a value of $1.25 million, and is allocated in ways that would tend to mitigate risk rather substantially, because this is a fairly risk-adverse portfolio. Now we can represent the same as this, a pie chart, because of course it's useful to do that. I can talk about the reaction to risk as moving the composition of this pie chart graphically, and that's easy to understand. But you can see the same proportions that I just listed in that file right here, in this Excel workbook component, is represented here in this portfolio. Now, we're not saying that this is a good portfolio or a bad portfolio, or don't even care really, because we want to talk about why you would change it, but it tends to be the kind of portfolio that I would regard as fairly typical. Now, for this portion of the class, we want to strip out the non-liquid assets, leaving only the liquid investment assets, because that's the only thing until we get to real estate that we want to talk about. So real estate is not a liquid asset in the sense that stocks are. You can turn your stocks into cash on your smartphone in 30 seconds if you want to do that. Or you can log into your account on your computer and do it there. You can do the same for bonds. You can't convert your house to a liquid asset without going through a real estate listing, hiring a broker, and all of that. So a house is a non-liquid asset. And some commodities are relatively non-liquid too. So we're going to take the stock and bond component of the portfolio and represent it down at the bottom. But we're also, for the purposes of this discussion, going to consolidate the stocks into one category stocks, whether they're owned individually or ETPs of stocks or mutual funds of stocks. All of that will be counted as stocks. And then bonds, whether owning bonds directly or owning mutual funds that consist of bonds. For the sake of convenience, we convert all of that to a category we're just calling bonds. And we might say that that proportion is 65-35. And so for a few weeks, we'll be talking about the composition of that portfolio. The equity portion of the portfolio that realizes all gains from capital gains and from dividends and is relatively volatile. And the bond portion of the portfolio, which, as we'll see, actually consists of a full range of assets, of which bonds are only part, bills, notes, and bonds, but we'll just call them bonds for right now. Those are interest-bearing financial assets that are relatively low in risk, although they do fluctuate in value, as we're going to see eventually. So when we take a look at making this adjustment, then we're saying let's take out the portion of our portfolio for the moment that is not liquid because it doesn't concern ourselves. And then we lump together stocks, whether they're individual stocks that we purchase, mutual funds or exchange-traded products, and we do the same for bonds. So we've got the portfolio set up for the moment, either very disaggregated as we started or extremely aggregated as we ended right here. And given this concept should be something you'll understand, we'll use both of those structures for the next few weeks to talk about why we react to market stimuli in the way that we do. This will enable us to begin talking about mutual funds. Now, I think all of you likely knew what mutual funds are before you ever signed up for this class, because they're so common in any family's budget. Your parents, almost every one of you, has some mutual funds. Maybe some of you, their parents don't. But if you're from the United States, you're likely to. And I'm using as an example in that chapter that I had you read, chapter 5, and here, one of the Vanguard funds. And I generally promote Vanguard funds. I get no compensation for that. They don't know that I even exist. I promote them as the Vanguard family you should look at initially, because they notoriously have by far the lowest fee structure of any mutual fund family. And that's because they were established by John Bogle, the famous mutual fund aficionado who has devoted his lifetime to pushing mutual fund fees down to rock bottom levels. He wrote a book that I'll tell you about. I should have brought it to class today, but I forgot that he even had it, about investing in mutual funds. It's a little too much to assign it. You don't need to read 300 pages on this. All you need to read is my chapter on this, and you know everything you need to know. So the one that I'm using as an example is the Vanguard Growth and Income Large Cap Fund. The symbol for that, and they have symbols just like stocks, is VQNPX. And this enormous fund invests in 1,324 large cap stocks, large cap only. And the fund had net total assets of $11.4 billion as of July 31st, 2019. Now, I used to use the huge Vanguard Admiral, I said that right, I guess, yeah, I guess it's people back there, huh? Admiral S&P 500 Index Fund. I stopped using that because the fund became ridiculous. It's so huge that you can't even think of it as a mutual fund anymore, and they've stopped taking contributions. It has in excess of $1 trillion in it, and it's a single mutual fund. But you can't contribute to it anyway because it's locked down. I have quite a bit of money in it, but I've invested in it long ago. Now, Chapter 5 gives you all this sort of dry and not all that interesting information about mutual funds. They're not really exciting assets to talk about, but that's a good thing. They're not exciting because they are very stable and they don't do much over their lifetime except earn progressively a very positive yield, and that's probably all you really should care about when we talk about them. But we're saying, of course, mutual funds diversify your stock investments or your bond investments or whatever their investment purpose is by accepting relatively small amounts from a really large pool of investors and then on your behalf buying the funds in the portfolio. The larger, better funds are net purchasers all of the time, like this one right here. They never sell anything, hardly. Most of them are passive in that they decide what group of stocks to invest in, and they don't change that ever unless the company disappears or something extreme happens. If you invest in an index fund, and that's not the example here, this is not an index fund, but the S&P 500 index fund is an index fund, then it not only invests in the same stocks that are represented by the index, but it does so in the same proportions as the market cap that represents the index. And so as goes the index, so goes your investment. So if you are invested in S&P 500 index fund, then if you want to know how you're doing, all you have to do is look at the S&P 500, and that'll tell you how you're doing. It's even the case that, for example, on this very first slide back here, when I showed you that, SPY is the ETF that trades in the S&P 500, and on the day that this ETF went ex-dividend, effectively the mutual fund did as well. And so the same dividend would be paid to the mutual fund, and that dividend would be distributed to you by the mutual fund on July the 31st, in this case, 2019. When you get a distribution from a mutual fund, you have your option of taking it in cash, and almost no one chooses that option, or else just having it reinvested right back into the mutual fund by increasing your share holdings of the fund by a tiny amount with every dividend payment. So let me go back and find, I really should have done that probably. Okay, so here we are. Yeah.
If all the stocks owned by a mutual fund have different ex-dividend days, then why does the mutual fund have a single ex-dividend day?
Why does it have a what?
Have a single ex-dividend day? If all the stocks they own have different ex-dividend days?
Why does it have a single activity day?
Have a single ex-dividend day.
Because that's the way the index itself works. It's the individual stocks don't, and they're paid to the fund, but the funds aggregate that, and then they announce a dividend date. So you would think maybe that they would just let it ride and let it roll in, but instead they aggregate and then announce over time. Okay, so there are more mutual funds traded than there are stocks, literally. Interestingly enough, there's about 2,000 or 3,000 more mutual funds than there are stocks. So they're very, very popular, of course. Now, the general fund families, as I say, this is not very interesting, but you kind of do need to know the difference when you're shopping. You have, first of all, the general major classes. You have your stock funds, like the one I just gave as an example. You have your bond and note funds, which are yield-bearing financial asset funds, consisting of U.S. Treasury bonds and corporate and other bonds and notes. You have your money market funds, which are mutual funds that consist of portfolios, I should say, that have yield-bearing assets with maturities of less than 1 year. These are the oldest of the funds. They're described briefly in the chapter in greater detail. They're not very popular now, except as a temporary holder of your money as you move it around. But these, for example, invest in 13-week Treasury bills and 26-week Treasury bills and 1-year Treasury bills. Financial assets that offer yield, that have yields of less than 1 year. They're hard to understand unless you understand how those types of assets are priced. So we come back to the pricing of money market mutual funds specifically after our section on bonds. Hybrid funds, which aren't very popular, are some mix, such as a bond stock mix. And then there's a special category that's been relatively new, that surfaced about 7 or 8 years ago, called target retirement funds. They're called other things as well, but this is one of the common names for them, such as the Target Retirement 2050 Fund or the 2055 Fund, which you're supposed to buy if you're planning to retire around, say, 2055 or 2050. You buy a fund with the date that's closest to your retirement. These are so-so in terms of popularity. I don't think they've quite taken off as much as the mutual fund industry hoped they would, because people still tend to prefer index funds. I still tend to recommend index funds, and I don't like target retirement funds for reasons I'm going to explain in this lecture. But they'll be offered to you probably in your 401k, because 401ks really like to use these target retirement funds. Now, within the first category, the equity or stock category, to further break it down, income funds are conservative, generally. I mean, there's kind of a gray area, really, between income and growth funds anymore. But income funds are seen, or ideally, kind of conservative companies that stress dividends and are established companies with perhaps in some cases recognizable names, or at least recognizable names if you're in the business community. So these are dividend payers. Growth funds are what we think of, for example, as the newer technology companies. These tend to be perceived as riskier. These target high capital gains. So these are companies that are trying to grow fast, for example. Fast growth companies. Again, this category, because so many of the technology companies are getting older and are changing their structure, as I say, it's kind of gray as to where Apple would fit currently in this. Because, as I've said, Apple is certainly not the torrid growth company that it once was, because its technologies are getting older, but they're still a very profitable company because they've transformed into being a cash cow. I was just looking today at the specs for the new iPhone 11, just the core phone, the $800 version of the iPhone. A pretty solid phone, but it's very similar, of course, to many others. Oh, by the way, I should tell you, I early ordered and paid $700. I'll probably regret that, for the new Linux phone, the Librem 5. It's in production. It's being released. It's running a version of Linux. And, of course, it's an anti-spy phone. It probably won't work, but nobody will be spying on me from here on out. So I'll show it to you when it comes in. It's $700, which is ridiculous, because that actually prices it almost as expensive as the new iPhone 11, the base iPhone, right, the middle-level iPhone, and the same as the OnePlus 7 Pro, which is that's what it's replacing for me, and it probably will perform like the $200 throwaway phone I have that I use as a backup sometimes on T-Mobile, but it's running Linux, so I'm going to be a pioneer. And I'll show it to you when I bring it in. Anyway, Apple's getting competition from everybody, including now Linux, so with that phone, but they make a lot of money on that, so they're a cash cow. So who knows whether Apple would be considered to be income or growth. Now, again, the index funds, as I say, I usually used to begin the introduction to Chapter 5 and to this lecture by giving your attention to the enormous Admiral Vanguard S&P 500 index fund. But as I said in the chapter, I had to move away from that example because it's in a class all by itself. It's so enormous, and it is also closed to you, so you can't use it. But index funds, of course, exist. There are lots of them. And again, they are defined to be such because they buy the components of an index at the weights that they have in the index. And those kinds of funds, if they're released by a popular fund family, don't sell our stocks ever unless the stock for some reason is kicked out of the fund or unless it's lost because of a merger or an acquisition. One of the reasons they're so popular, as we'll see here in a minute, is because they have a very low churn rate, they don't have a lot of turnover, and so therefore they have very, very low transactions costs associated with them. They're not buying and selling and buying and selling and buying and selling. The distinction, by the way, between these two classes of funds, managed funds refers to funds that the fund managers are buying and selling and buying and selling, trying to kind of beat the market like maybe you would, whereas an index fund is a fund that is unmanaged. That is to say, they just match the index and that's all they do. And as we'll see here from the data, increasingly the investing public simply wants to buy index funds. And there's a good reason. I'll point out to you now, and I'll point out to you multiple times, that the rate of return on index funds historically has always beat generally the rate of return on managed funds, especially in the long run. You just can't beat investing in the S&P 500 and not caring any more about it. And there, in any given year, there'll be 10% or 15% of the managed funds will outperform the S&P 500, but in the next year, those same funds won't be there. It'll be a different batch of 10 or 15%. So no managed fund ever seems to be ahead of the S&P 500 over, say, 10, 15, 20, 25, or 30 years of time. And even if you could find one, nonetheless, it wouldn't beat the S&P 500 by it very much. Specialty funds I go to some trouble to talk about in the chapter, so I won't say much about it here, but those are sector funds, for example. You can buy a fund in just gold and gold mining. And I mentioned in the chapter that in 2003, when I realized that there was going to likely be at some point a recovery from the downturn, I had reasons to believe that two sectors would be exceptionally strong. Gold and gold mining, that's one sector, and the other sector would be oil and oil service companies. So as we reinvested our portfolio and moved back into stocks, then we put a fairly high proportion of that investment in those two sectors, gold and gold mining, oil and oil service companies. And one of those in the next 7 or 8 years tripled in value and the other quadrupled in value. And I forget now which was which. I think in the chapter I say which was which, because the gold mining stocks just went nuts, and as did Exxon and Schlumberger and Baker Brothers and all these stocks that are in the oil business. They kind of peaked out in 2008. I think we sold our position out in 2006 or 7 or so. So if you're an engineer in a hot sector and you know that it's emerging, especially in technology, like there's some mutual funds and ETFs in cybersecurity, for example. For about 2 years, the cybersecurity stocks were as hot as a pistol, like FireEye. And I bought some of those too, but I stayed in them too long. They didn't keep their attractiveness. I think it's because they stripped way out ahead of their earnings. Their earnings didn't grow as much as one would have thought, given the importance of security. And the stock prices outstripped their earnings and came back down. But there are small cap specialties, just small stocks, mid cap specialties. Every sector imaginable, you can find a mutual fund or an ETF that represents it. And every industry has representation. If, for example, you say, I want a mutual fund just for banking industry, then you'll be able to find a wide selection of those. You can also find generic categories like technology, like the T. Rowe Price Science and Technology Fund that I use as an example. And then, of course, there's all kinds of mixed and hybrid funds. And this is the market breakdown of them shown here. That's the same chart as in the book. The standard domestic equity makes up 38% of all of our investments. World equity, and this is in the United States, world equity makes up 14%, so we buy a lot of stocks for mutual funds representing foreign markets in Japan and in Korea, in Taiwan, South America, obviously European Union and the like. Bond funds still take a big chunk of our investment. And right now, money market funds do as well. And the bond and money market are in the same category, which is to say they're yield-bearing financial assets. It's just the money market are assets of maturities of less than 1 year, but the two represent 40% of the total portfolio. And as you can see, the hybrid funds represent only 8% of the total, so that has not been an attractive option for most investors. It's very easy to talk about mutual fund fees. I used to make a big deal in this class giving an assignment where you would go out and find a mutual fund that you liked from a mutual fund family, and then you would have to collect and write down the fees associated with owning that fund and turn them in. And I would sort through them and pull out some interesting examples and then read them off to the class, because the fee structure for mutual funds up until about a decade ago was all over the map. And you would find very, very high fee structures, very, very low fee structures. Right now, though, you have a choice of so many funds that basically have no fees at all. I'll first make that point and stress that you can find these everywhere, and you should never pay any kind of fee other than rock bottom fee for a mutual fund. Then I'll talk about exceptions to that. Not exceptions that you'll use, exceptions that others use. Now, when you look in a mutual fund's portfolio, or even when you look on their website at the material they're required by the Securities and Exchange Commission and other regulatory agencies to show, they generally list their fees under these categories. Now, I'm noticing they're muddling the fees together, and I have to assume that that's because the regulatory agencies, as they always do, are sort of backing down on having adequate regulation for this industry, because they're just subject to the pressure from the industry to do that. That's a loss. Although if you go to the prospectus, on the other hand, you can almost always find these outlined in detail. You'll notice when you go to take a look at a mutual fund family, and at some point you should do this. I used to assign it as mandatory, and I figured, oh, they've given them, this is just before the exam. I don't want to give you a mandatory assignment just before the exam. But you should go to Vanguard or to the T. Rowe Price mutual fund family and look at some funds and see what they say about them. And you'll see how the advertising and the taxonomy of the funds are set up by the fund family. And you can see it's pretty easy to shop for these funds. But you'll see under the fee structure that they'll have these things listed. And so they're listed as expense ratio. They're required to list that. Loads, CDSC and other deferred charges, management fees, which are now usually subsumed under the expense ratio, and the 12B1 fee. And that's the advertising fee. They can actually charge you a rate where they could use the proceeds to advertise the fund to others. So, and that's called the 12B1. And so what you should pay. So the expense ratio is the summary, all of them except loads. The loads are the sales commission charge, the charge they charge you specifically to sell you the fund or buy it back from you. That term is called a load. The CDSC fee is to rob you, and that's all you need to know about it. The management fee is their cost for managing the fund. They say, I'm going to take 1% of the fund and pay ourselves as a management company for managing it. And it is usually now, as I say, subsumed under the expense ratio in good funds because it's the only fee there is. And the 12B1 is the advertising fee. So the acceptable level for you is for the expense ratio, it must be below 1%, and it should be very much below 1%, typically below 1/2 of 1%, or even below 4/10 of 1%, and possibly below 1/4 of 1%, and even as low as 1/10 of 1%, which is where you find the Vanguard funds. And that literally means that if you have per $100 in that mutual fund, if it is 1/2 of 1%, then they'll take out 50 cents per $100 per year as their cost for managing the fund. Scalable up to any amount, of course. Although the scalability actually starts to back off because with larger fund amounts, the fees even go down more. And that's not very much to manage your fund. The loads you should pay are always none. The CDSC and other fees you should pay are always none. The management fee you should pay should be the same as the expense ratio, and the 12B1 that you should pay is always none. So when you look for a fund and you shop for the fund, if it lists any fee there that's not zero, then you leave that fund family or at least leave that fund. Now there's two reasons for that. Anything above zero is a ripoff. But secondly, I guarantee you will be able to find that fund from another fund family or even that fund family at zero fees, no matter what it is you're looking for. Remember, there are 8,000 of them out there approximately right now. That's more than stocks are listed in the United States, unless you include the over-the-counter market. There will be what you're looking for. Now, I'll say a little bit more about that so you'll understand this. If you walk into a bank, for example, and ask them to help you set up a mutual fund family or a large private brokerage house like Merrill Lynch used to be and set up a mutual fund family, they will be willing to do that for you, but they will charge these fees. If you sit down at a little desk in a Wells Fargo bank, the person sitting there will charge you these fees. They'll charge you loads to get into the fund, and the load may be as high as 5% of the value of the investment. So if you're putting in $10,000, then you're going to pay $500 to invest in that mutual fund to start with. On top of that, their expense ratio is likely to be well in excess of 1%. Likewise, there may be a charge that they will levy upon you, the deferred sales charge, that's a CDSC, that you'll have to pay when you try to leave the fund. So you call them up and say, I want to move my money somewhere else. Sure, no problem. We'll charge you 5% to do that. And of course, the 12B1 is what you pay for them to advertise on television so other people will buy their fund. That's often 1/4 of 1%. Now, so you say, yeah, that makes sense because if I do it online at Vanguard, I don't have to talk to a person at all, ever. I can go for 40 years without ever having a conversation with a single human being on Vanguard. So the labor cost of managing my account is trivially low. They will, however, answer the phone and talk to you all day at Vanguard if you want to. But mutual funds are so easy to work with and manage, their customer service costs are actually nonetheless not that high. And they can afford to actually do that for you and still not charge a lot of money. That's not a sales act. That's an act of helping you, get your account set up or make some decisions about where to move your money to or something like that. That's not a salesman or a saleswoman's job, unlike if you walk into a bank like Wells Fargo. Their job is to sell you the mutual fund. They have to get paid. The Mercedes that they drive has to be paid for, and the building they're in has to be paid for, and their supervisor's salary has to be paid for. And the only way that you're going to be able to get a service that's that labor intensive is if you pay the 5% or so they're asking at the outset. Now, here's what people don't necessarily understand. What I've just said should make sense to you. Well, of course, if I do it all myself, then the fees should likely be lower. So I'll have to look for mutual funds that have this low fee structure so I can take advantage of that. Oh, it has nothing to do with the choice of funds. The Wells Fargo person will sell you exactly the same fund as you would have chosen had you simply gone online to do it yourself. In fact, they rank them, some of the fund families do this, they rank them as Class A or Class B or Class C type fund. And a Class A fund is that fund if you buy it through a broker and pay 5%. Class B is exactly the same fund if you buy it online and you don't pay the 5%. It's managed by the same group. It has the same NAV. It's the same investment exactly. The difference in the class is how you acquired it. So it's actually the case that for anything that you are sold, if you go into Wells Fargo or any place that charges loads or fees, that same fund almost always is available as a no-load fund. So because they don't have a separate set of funds that they charge money for, they use the same funds as everybody else. So there's no reason for you to do it. You may ask for advice, but you don't need advice. I'm telling you what you do right now. If you think you need advice and don't know what to do, buy an S&P 500 index fund. That's the end of the advice. That's what the one thing Josh Jones remembers from when he was in this class, because he got really rich really young and he invested his money. He says, I remember Evans told me if I didn't know what to do, buy an S&P 500 index fund. So that's what he did. And the payoff for that is likely to be as high or higher as any cornucopia of portfolios that anybody recommends to you who sits at your desk, at their desk, and talks to you for hours on end while racking up the charges. So that's all you need to know about this. That's all you need to know about 60% of the investment advice you're ever going to get in your life, actually. Yeah.
If banks have like Class A, Class B, Class C, the only difference is the amount of fees they get from it. Why don't they just only have Class A and always take fees?
Well, because you don't know this. You didn't know this until I just told you, right? So that's why. That's knowledge is power. Knowledge is also wealth. They don't know this. Your parents may not know it. They probably do. The parents of people that go to technical schools are usually pretty well informed, but the generic parents out there don't necessarily know this. People don't know this stuff. It's as simple as that. The fees that you can be charged in finance in general are charged based upon your ignorance. And it's partly, what fund did I buy? What fund should I buy? There's 8,000. I don't even know where to start. It's not that hard because you just buy an index fund, and that's all there is to it, if you don't know.
Why would a fund stop accepting new contributions?
It's too large. It's just too large. It's the S&P 500 fund, they don't want to take any more money. They control in excess of $1 trillion, and they're one mutual fund. It's like 3 trillion. It's not just one. Whatever it is I say in the book, it's a really large number. That's just too much money in one fund, right there. So they said, we can't do this anymore. Now, these are fees here I'm talking about, though, that are stated, at least you are informed that you will be paying them, and you're aware of that. They advertise, but you know it. You sign a document saying, I agree. But there are also hidden fees far more important associated with mutual funds that you don't necessarily know about and that you can pay even if you buy the fund on a website that says load 0, CDS 0, management fee same as expense in 12B10. You can still buy a fund that has a high churn fee or hidden fee. Now, the Wall Street Journal in a significant article published in 2010, the hidden costs of mutual funds, it picked up a lot of attention, pointed out that high churn, that term means high turnover, managed funds, remember managed funds are funds where the fund managers buy and sell to try to beat the market. Their goal, in fact, is to outperform the S&P 500. Many of those have turnover rates of 100%. That means they go through their entire portfolio in 1 year. And that's a lot. Many of them have 80%, in compared to an index fund, which will have a turnover ratio of 6% or so. They generate excessive hidden fees that aren't shown in the expenses because there's no way to show them. Every time they buy or sell a stock or a bond, then they pay a brokerage commission just like you do. And it's not very high as a percentage of the transaction. But if you keep buying and selling, it begins to add up over time. And again, if you have a 5 or 6% yield compounding on a mutual fund, if you're squandering 2% of that on brokerage fees, which isn't a very high percent, that still reduces the yield by 1/3. Because, of course, we're talking about funds that yield maybe 6 or 7 or 8%. The bid-ask spreads, as you now know, will take a bite out of every single transaction, right? That's why spread arbitrage exists. That's why the algo traders that are in there are making profits. They're making a profit off the bid-ask spread. So where does that come from? That comes from the whoever's actually trading with them. Now, it is a fair exchange as far as I'm concerned because the algo trading activity reduces that spread to a penny, typically for the largely traded stocks, so that they get that penny is certainly not a problem as far as I'm concerned. If you compare that back to the 70s and 80s, when stocks were priced as 1/8, the price would be 12 1/8 or 12 3/8 or 12 1/4, not $12.23. The minimum spread, therefore, was 12.5 cents as opposed to a penny. And research showed that they tend to keep them at 2/8 apart or a quarter apart. The average spread was actually a quarter. You're better off as a trader these days, as a retail trader, letting the algo traders get their penny or two while they keep the spread down to that, a penny or two, rather than letting the market specialists walk away with a 25-cent or 37-cent or 50-cent spread. But still, the bid-ask spread is a little bit of a tax every time you trade because you're always taking the lower of those two. Far more important, though, that this article pointed out and that I often stress is the market impact of these kinds of trades. Remember when we talked about dark pools and I was making a big deal about dark pools and why they exist? I said they're there to mitigate market impact for large trades. And despite the criticism of them, they're necessary. That's why I don't criticize them so long as they do their job. Without them, the market impact of large trades would be greater than it is now, and you would be paying the cost of that because it would be borne as hidden fees in mutual funds that you own. Because if they wanted to sell, you were asking a second ago, why did they stop at $2 trillion, right? Well, if a company drops out of the S&P 500 in a $2 trillion portfolio, that means they have to sell off, say, $100 million worth of a single stock. And that's going to have really massive market impact. They have to sell it off because, of course, it's not in the S&P 500 anymore. The problem is so large that when you look at the makeup of the S&P 500 mutual funds, there's 500 stocks in the S&P 500, right? They all have 503, 504, 509 stocks in their portfolio. And the reason is because of this market impact, they're given a long time to divest of those stocks that are no longer in the S&P 500. Otherwise, they would be killed by the market impact of having to divest. Their holdings are so large. So that tells you that, yeah, even in the T. Rowe Price Science and Technology Fund, and maybe they're getting rid of FireEye, or they're deciding to add FireEye to the portfolio because they want to stress cybersecurity a little bit more. If they have to sell 300,000 or 400,000 shares or 1 million shares of FireEye, that's going to have market impact to some extent. And that's going to be reflected as a higher cost than would be reflected if you were trying to sell it. They can't sell it as easily as you can, and if the price drops down and you jump on that and get rid of your 200 shares, they don't have the option of doing that. This is something, by the way, I study extensively, because when you trade options and the like, this kind of heavy activity trading tells you a little bit about where the market is going. And so a lot of the computer programs that tap into these markets, that digest this and give you some hints and clues about things, are looking at the depths of these bid and ask queues to see if they can see market impact coming on inadvertently by large traders. Remember, back in the dark pool stuff, we said, as often as not, they try to break these transactions up into smaller transactions, but you can only do that so much. So anyway, all of this can't show up in the expense ratio. It just shows up as the fund not performing quite as well as you think it should, because these kinds of fees, the bid-ask spread, the market impact, simply result in a lower level of performance than you would expect that to have. There's no way to measure that, and if you own this mutual fund, there's no way you would know that this is a problem, unless you read the Wall Street Journal article or listened to this lecture or an equivalent lecture. So the latter reflects that large-scale transactions potentially involves dark pools and internet sweep orders. I used to give lectures on internet sweep orders. I took them out finally because nobody understood what the hell I was saying. But this is one of the ways where you sell large blocks. You send a huge order to one market, but you sweep it out to all markets. They just fan it out. It's kind of if you understand the programming behind it, it's actually not all that complicated, but to try to describe it without the programming, it turns out to be too difficult to do. So again, the market impact is the big deal, and some analysts estimate this hidden cost to be as high as 3%. So you're saying, the fund should have returned 10% this year and only returned 7%. It has a low fee expense ratio of 0.5, 1/2 of 1%. But it seems to be about 3% below what that portfolio should have done. That's because of these hidden fees. Now, that's why I don't like high turnover funds in general, and why specifically I don't like target retirement funds, because they have high turnovers. And the turnover ratio for them is in the prospectus, and when you read it, you'll see that they have really high turnover. More on the churn issue. This is from a prospectus in the Vanguard 500 Index Fund. This is the one that's actually closed. So they say, to warn you, the fund pays transactions costs such as commissions when it buys and sells securities or turns over its portfolio. A higher portfolio turnover rate may indicate higher transactions costs and may result in more taxes when fund shares are held in a taxable account. That's another issue. We can bring that up in a few minutes. These costs, which are not reflected in annual operating expenses or in the previous expense examples, those being the ones I just gave, the 12B1 and all that stuff, reduce the fund's performance. During the most recent fiscal year, the fund's portfolio turnover rate was 3% of the average value of its portfolio. So that's the S&P 500. Turnover ratio, the churn rate's 3%. You see target retirement funds that have churn rates of 150%. There's no way that they are escaping the fees in those 150% churn. The important point that you need to understand, that you need to take away from this, though, is those churn transactions fees are not represented in the fund's fee structure. There's no way to represent it. It just results in lower performance that you won't necessarily understand. These are internal and they show up merely as reduced yield. This is the primary problem with managed funds and especially target yield funds. Now, again, the one component of that that's difficult to understate is the market impact part. Because I see it. I see these big trades all the time. And you can see these stocks going along, clipping along with bids and asks. All of a sudden it'll pop down all of a sudden for some reason because somebody is doing a sell side big trade. And you jump in there and you grab something for a couple of hundred shares. And you say, hey, I saved $1 or $1.20 or something like that. When I buy, I almost never buy without trying to jump into that kind of downturn. And for heavily traded stocks, you'll see them all day long. And you save $1.20 or so. By that I mean if it's trading for 45.35 right now, and I say, look at this. This thing has been popping down about $1 or so every 15 or 20 minutes, no matter what is trending. That means somebody's trying to sell some of this. So what I'm going to do is I'm going to put a limit order in $1 under market, say 44.42. And let's let it sit there. And then all of a sudden it pops down, it gets picked up, and I buy my stock for $1 less than the market was at the moment I wanted to buy it. That's me taking advantage of market impact from a large trader trying to get rid of their portfolio in small transactions. So it actually helps the small investor to be aware of this, but it's impossible for the mutual fund to do that. They're, in fact, probably the person you're taking advantage of when you are making these small transactions. Then, and we'll stop with this, to add to that are the tax issues. And these are complicated. Okay. Now, as I point out bitterly in Chapter 5, the tax rules for mutual funds are flat out unfair. They're ridiculous, in fact. So you say, okay, let me buy a T. Rowe Price Science and Technology Fund. Let me put $10,000 into it on January 1st, 2017. Come April 15th, 2018, I say I don't owe a penny on the T. Rowe Price Fund for taxes because I didn't sell it. I didn't get a capital gain. I may owe a little bit if they paid dividends because the dividends are taxable, but that would be trivial. And all of a sudden you see a document that says you have a fairly sizable tax bill for the T. Rowe Price Science and Technology Fund. So why is that? It's because if the fund manager sells any stock in the portfolio, it's taxed as though you sold it. So they may have, I think the T. Rowe Price Fund has 40-some stocks. So if they sell FireEye because it's going down, or let's say it's going up because that gives a capital gain. They sell FireEye to take advantage of the fact that it's rising. That creates an income gain or a capital gain for you, not for them. And you will end up having to pay the capital gain on that stock transaction, even though you didn't even know it took place. You'll get a document at the end of the year, the one I describe in the book, the 1099 div, I think it is. It says you owe $4.45 or $45.80 because of the transactions made in the T. Rowe Price Science and Technology Fund. Say, I didn't trade anything. Well, you didn't, but they did. And that's unfair. ETFs, you don't have to do that. So the rule isn't the same for ETFs as it is for mutual funds. Now, also, if that stock was held for more than a year, though, by them, not by you, then you at least only have to pay the capital gains tax, which is shown right here. If, on the other hand, it was held for less than a year, then you have to pay the tax at your personal income tax rate, which is way above the capital gains tax. And usually, I'd like to say that they'll hold on a stock for more than a year before they do that, but on these heavily churned funds, sometimes they don't. And so not only do you get a tax, but you get a tax that's higher than the capital gains tax. Now, so the rule of thumb, by the way, on these kinds of securities, if you do buy and sell them directly like stocks, if you hold a stock for more than a year and sell it and make a capital gain, then you pay the capital gains tax rate instead of your personal income rate. If you hold the stock and sell it, or financial asset, and sell it in less than a year, you pay it at your personal income tax rate. And that's going to be, for you especially, much, much higher. Now, the same law that lowered the corporate income taxes also lowered the long-term capital gains tax rate. So this is for long-term capital gains. This is what it is. You either 20%, 15%, or 0%. And what bracket you're in depends upon your income. And that's adjusted income as shown on the 1040. That depends upon whether you're single, joint, head of household. There's another category that I don't show here, married filing as single. So, for example, if you're single, your income is below $40,000, you're in the 0%. So all of you are going to be in the 15% bracket when you graduate and get your job, because you'll be making more than $40,000, but you'll be making less than $434,000. So that means that for you, you'll have a 15% capital gains tax, but your personal tax rate at the federal level will probably be 25 or 32 or something considerably higher than this. So again, I want to make sure I get to the point before I answer the questions. A heavily churned fund with a high turnover rate, if it is not in a tax-free account like a 401k, is going to also generate a much higher tax liability than will the S&P 500 index fund, maybe considerably so. So once you take into account that the index fund does not have a high churn rate, therefore does not have to pay these hidden fees, the bid-ask spread, and the brokerage fees, and on top of that, you don't owe a high capital gains tax rate, there's no reason to be buying anything except index funds, unless you expect the non-index fund to really be outperforming that index fund, and they generally don't do that, because the after-fee cost is simply not worth it, okay? So that kind of general theme is something that's likely to show up on the exam, kind of the big picture stuff, right? Unfortunately, I'm not giving essay questions this year because the class is too large for me to do it, but that's kind of a candidate for an essay question, right? Why do a lot of financial advisors advise you only buy index funds for your retirement portfolio as opposed to managed funds? So a weak answer would be something like the fees are lower and the taxes are higher without explaining it. And the student here who's just a maniac for getting questions right, well, this big long essay about, the fees are lower, here's why, and the hidden fee and so forth. Here's the example and so forth. Here's a diagram, here's a chart in Excel, three-dimensional. And so on the essay exams, of course, you get the full range of answers all the way from, good enough to outstanding. But unfortunately, on the multiple choice question and the like, we just have to kind of try to break all these issues down into subjective answers and questions, unfortunately. Okay, I'm going to take a question and we'll stop with this right here. Yeah.
If you don't get a capital gains on, so when you're selling and you actually have a capital loss, would you still have to pay taxes?
Yeah, capital losses count the other way. You certainly count those to your advantage, just like it does. And inside the fund as well. That's right. Yeah. So if they have a loss, that'll help out a little bit. Now, what it, of course, does is reduce, ultimately, the tax liability of that fund, unless you really have a crummy fund, in which case your tax situation is not your biggest problem, obviously. So, okay. Look for my emails, because I will tell you about the practice exam and all that stuff by email, all right? And tell your friends who are watching this on video to start getting caught up, because they haven't heard all the stuff that you just heard today. Not that you should care, it's competitive. Perhaps don't tell them. Tell them the exam was postponed for a month.
So sorry, we don't have the test, so.